Okay, we continue from where we ended last evening. Today we'll look at particularly on the URP unrealized profits, how to treat unrealized profit. We'll continue and start looking at some few other adjustments that you may expect in the exam. So the first adjustment that we are going to discuss here, and it shall be discussed in a very, very logical way, very simple way, is the intra-company balances. So, first thing that we have to recognize, Loco and Victor, is that these companies, they are separate entities. They have their own lives, and it's possible that they can trade amongst themselves. So there'll be issues such as the subsidiary company supplying goods to the parent company, for example, on credit. So if it is on credit,
not sure whether it's my network or it's yours, because you are breaking.
Look,
yeah, it's breaking over.
It's breaking. Okay, let me using my phone. I'm using
Coach, I think it's Coach's network.
Yeah,
okay.
It must be, because it was breaking on my side. Yes,
Okay.
sir.
Let me do this.
Yeah, it's also breaking on my side. I don't know if we are
Okay,
breaking.
I'm changing the network.
Okay,
so what I was saying is that today we'll look at some few possible adjustments that you may face in the exam. One of them is on the intra-company balances. We expect that these companies, being separate entities as they are, or independent firms, they may actually trade amongst themselves. So if that would be the case, then we expect that there may be some receivables or payables which are intra-related. For example, the subsidiary company may supply goods to the parent company on credit. And obviously the subsidiary company will record that in their balance sheet as a receivable, whereas the parent company will record it as a payable. But then, at the point of consolidation, we remove that right of them being separate companies, because at that point we want to consolidate them. So we want to create one entity, like marriage of some kind, biblically so. So what it means that where you have receivables and payables from the other side, where the subsidiary company has recorded whatever is owed to them by the parent company as a receivable, the parent company will record it as a payable. These intra-dealings, they will need to be cancelled.
okay.
Tim, are you getting me?
Yes.
Mm-hmm. The basic example is Luke gets a 50 pull-up from Mamlam. So he tells the wife that borrow me or lend me a 50 pull-up. Before this transaction, before this deal, the wife had $1,000 in the account. Luke had $500 in the account. Then Luke goes to the wife, who obviously is my mlam. In Zambia, we call them mlam. Goes there and says, honey, lend me a $50. I'll give it to you in the next 4 days. And my sister-in-law, who is my mlam, gets a $50 and gives it to Luke on credit. So there are two, and we have to recognize this arrangement, Victor, that there are two separate entities. They have two lives, and no wonder they die differently at different times, isn't it? The wife and husband, isn't it? So in the books of my sister-in-law, she's counting that Luke owes her a $50. In the books of Luke as a separate entity, he is also counting that he owes my sister-in-law a $50. But there comes a biblical realization that a wife and a husband, they are one. So at that point, we'll have to do the consolidation. So when we consolidate, what will be the wealth? How much money will this consolidated arrangement have? Victor, I don't know if you heard the scenario. I don't know if you follow the scenario. Look, in the bank account had 500. The wife had 1,000. Then Luke goes to borrow a 50 rands. So if you are doing the consolidation, how much would it be?
Actually, there was a meme that was going on the rounds, I think a week or 2 weeks ago. The wives were posting that this is how I sleep when I realize I've borrowed money from my husband. So because they know that there's no way you're going to claim that money. So remove the payable, remove the receivable.
Absolutely. Yeah, absolutely. So then what is going to happen is, look, how much would the Shoniwa family have? How much wealth would they have? You had remember at the 500, she had the 1,000, and you asked for 500 for 50 from her. So how much would it be? As the Shoniwa,
it would still be 1.5.
Yes, it should be 1.5 because you have to cancel the intra dealings. This is where this concept is coming from. Does it make sense now?
Yes, it does.
Yes, it does make sense.
Then there will also be issues of cash in transit. I don't know now with the efficiency in the lending of financial systems. I don't know if this is still applicable. Obviously it is, because there will be some days, it may take maybe 2 or 3 days for it to clear up, depending on the amounts. Where, say, the subsidiary sold goods to the parent company on credit, let's say worth 100 kwacha. So in the books of the subsidiary, it shows it's 100 kwacha. But the parent company, just a day before the consolidation, the parent company paid a 40 kwacha through a bank transfer, which did not reflect immediately on the books of the subsidiary. So the subsidiary, they also assume that the receivables are still 100 kwacha. But on the books of the parent company, they have recorded a 60 kwacha because they paid a 40 kwacha through a bank transfer. That 40 kwacha from this end of the subsidiary, from the side of the subsidiary, it is being regarded as a cash in transit, and it has to be recognized. So they will need to debit cash and credit the receivables. So the receivables will reduce by 40 kwacha, whereas cash will increase by 40 kwacha. Once that is done, step 2 will be to cancel the 60 kwacha, which is the 60 kwacha which has to sit, or is supposed to sit on the books of the subsidiary as a receivable, and on the other end, on the books of the parent company as a payable. So those have to be cancelled. Are you getting me, Tim?
Yes.
Yes.
It's storytelling, but it has to be logical. So let's just look at this simple, or just an illustration on cash in transit. P has an intra-company, or the parent company has an intra-company trade receivable of 1,500 kwacha at the year end, due from S. This does not agree with the corresponding 1,000 kwacha trade payable in S due to a check of 500 kwacha sent by S immediately prior to the year end. So we know that the subsidiary company sent a 500 and the parent company, they were not aware. So they still indicated a 1,500. So all we are actually saying is that the best way to cure this problem would be to debit cash the 500 and credit the receivables with the 500. Then the next step would be to cancel the 1,000 from both ends, from the parent company and the subsidiary company, and it ends there. You would have sorted out this problem. So if it is inventory in transit, it should be the same thing. You're going to debit inventory and credit the payables. It's basically the same principle that you're going to use on cash in transit. So it will be like this. Look, it is logical, isn't it?
Yes, it is.
Yeah, it is.
So we now come to unrealized profits. Maybe let me just do a storytelling as well on this one. Let me first stop sharing. A bit of storytelling. It is fine, isn't it?
Yes.
So unrealized profits, or others they call it PUP, PUP, provision for unrealized profits. On this one, guys, as long as trade is within the group and nothing has gone to the outside world, whatever profit that you are going to regard as a subsidiary or a parent company for selling goods to to the, for example, if you're a subsidiary company, for selling goods to the parent company, which haven't been sold to what we call the outside world. Whatever profits that you made through that sale is going to be regarded as unrealized. It will be the same scenario of Luke and Mamlam. If that 50 puller, Luke decided to go and, maybe because he's involved in shylocking, to go and lend it out to other people at 75 kwacha, then we're actually saying that there has been a profit of 25 kwacha, and that profit of 25 rands is actually going to be realized because it is not within the family. So as long as you are not selling to the outside world, whatever profits you recorded, that profit, please cancel it. It is unrealized. So there are two scenarios here, which most of the times the students get confused because they don't go to academies like this one where they are taught logic to say, wait a minute, whoever was coming up with this theory, with this line of thought, what was he thinking about? Is it logical? And I've always believed in, when I look at all the standards in advanced financial reporting, when I look at all the topics, they are all logical. They come from something logical. So we say, let's remove ourselves from the textbook thinking. Let's get into the mind of whoever came up with this thinking. And obviously, for coming up with this thinking, it was peer reviewed. It was peer reviewed and people saw logic in it. So there are two things here that confuses students. One, if it's a parent company that has sold goods which haven't been realized, whose profits hasn't been realized to the parent company, what happens? Two, if it is the subsidiary company that is selling goods to the parent company, and there's a portion that hasn't been realized as profit, what happens? So let's start with the first scenario where the parent company sells goods to the subsidiary company and counts a profit because they have sold it at a margin or at a markup, because markup is on cost, margin is on sales. So they have sold it at a markup. In the books of the subsidiary of the parent company, this is the parent company, let's say it's the parent company that is selling. So in the books of the parent company, in the income statement, is that they are going to show revenues. Whatever they have sold to the outside world and what they have sold to the subsidiary company. So if it's 200, they will show 200 rands up there. They'll even record their profit because of the costs that will come in and all that. So they'll record a profit. That profit, look, it will find anything that you see in the income statement eventually finds itself in the balance sheet. I've always said the balance sheet and the income statement is just one statement, but someone clever decided to separate it. So whatever is in the income statement, in whichever way you look at it, will find itself in the balance sheet. And in this case, that profit that has been recorded, even a component that wasn't realized, will find itself in the balance sheet through what? Through retained earnings. Victor, are you getting me?
Yes.
So it will come in through retained earnings. But remember that that profit is overstated. It's overstated by that profit which wasn't realized. For the parent company, because they believe that they're a separate company And it is fair play for them to have recorded it as a profit. But at the point of consolidation, you realize that this profit wasn't actually realized because there was no outside transaction that influenced that profit. So it's still within the group. So what does it mean if it's the parent company? If it's the parent company, please adjust working 5. Which is working 5? You need to have that method go. Which is working 5?
Group retained the earnings.
Group retained earnings, RE, or just religious education. Group retained earnings.
Okay.
So adjust where you are showing under P, retained earnings. Remember that we always have 100% P. Adjust that by that realized and realized profit. Because that profit is overstated. It is not true. It was not realized. Then, the other scenario, the second scenario, where the subsidiary company sells goods to the parent company at a profit. Unfortunately, a certain portion of the goods that were actually bought from the subsidiary company were not sold to the outside world. Therefore, there's a component of unrealized profit. Now, let's ignore, because unfortunately why people get confused, they only look at the balance sheet. Like I said, elements that are in the balance sheet, they are all of them, those that are coming from the income statement, they're coming into the balance sheet. But in this balance sheet, they are going through the back door, through the retained earnings. Otherwise, it's possible bringing in your income, your revenues in your balance sheet and do your columns to get your balance sheet balance. So the subsidiary company, let's go back to the income statement. After the subsidiary company has sold these goods to the parent company at a profit, they will genuinely, innocently, and through fair play, they will show the revenues that they have made. That is both from the parent company and from the sales made outside the world. So they will show the revenues, they will show whatever associated costs, they will show the profit in case there's a profit. So now, with that profit, there will be a component in it which is unrealized. So meaning that profit has been overstated by the unrealized profit. So the common thing that you have to do is to make an adjustment. And this adjustment, you can only make it in working 2. Which is working 2?
Net assets of the subsidiary.
Net assets in the subsidiary.
The subsidiary.
So then what you're going to do there, you remember that in the net assets in the subsidiary, there are 4 columns. There's a first column where you do your descriptions, which is copy and paste of what you're getting from the capital and equity portion of your balance sheet. Copy and paste. So you're going to put it there. But because there's an realized profit, which the subsidiary company recorded as profit, you will need to add another line, which you are going to call PUP, provision for unrealized profit. So at the report date, so there will be now the second column will be at report date. At report date, basically it's what you are seeing in the balance sheet which the examiner has given you. So you're going to show if there's share capital, share premium, retained earnings. Then on the unrealized, because you have computed the unrealized profit, you need to include it there, but put it in negative because you are trying to subtract. Then you're going to show at acquisition. At acquisition, that unrealized is not affecting at acquisition, because any transaction that was done before acquisition, that profit is realized. At that time, there was no relationship whatsoever. So you are going to show at report date the unrealized, but on the third column where you have at acquisition, you're going to leave it blank there because it doesn't matter. Any transaction that was done before acquiring shares in the subsidiary, that is a normal business practice, and the profits that were recorded were genuinely recorded and should not be reversed, must not be reversed, shall never be reversed at all. Then the fourth column, which is post-acquisition. This is where that unrealized profit will go to and adjust your post-acquisition balance. Does it make sense? Is the storytelling okay? Can we go back to the presentation?
Yeah.
Yes, it makes sense.
Sure, thank you.
I think I had confusion there.
Yeah, you had confusion, right?
Yeah, the storytelling that there is a scenario where the parent is selling to the subsidiary, then you adjust the retained earnings. When the subsidiary is the one which sold to the parent, and then you adjust in the working to net assets of subsidiary. I think that concept, I didn't have that concept.
Okay. So but then now it makes sense. You don't even need to read more of the books. When you come at the academy, why you're coming here is to reduce on your confusion.
Yeah, that's it. That's it.
Because you see, it's just like I'm saying, Victor, it's logical. The parent company has sold the goods to the subsidiary company. Whatever profit they recorded there, obviously, in the revenues, you'll see the revenues going up. Then the minus cost, you see the profits. But you know that profit component, there's a component in it which wasn't realized, which has to be adjusted. Meaning that as a group, that has to be done what? That has to be adjusted. So where are you going to adjust it? Because that profit was made by the parent company. You cannot adjust it in working two, because working two, it is specifically net assets in the subsidiary. So you can only adjust that when you are doing your group retains earnings computation. You cannot adjust it in working one because there you are only looking at the structure itself, the share structure. You are not going to reduce it in working two because in working two, you are only looking at the net assets in the subsidiary. You are not going to adjust it in your goodwill, because in the goodwill, at that point, any transactions that were done, any business transaction that were done amongst these two companies was normal because they were not related, isn't it?
Yeah.
In the working three, when you're doing your goodwill. So if there was any transaction that was done by these two companies, it was normal, they were never related. Then you cannot adjust in working four on the NCI, because at that point they were not related. The parent company, the now parent company, the subsidiary company, they were not related. So you cannot make those adjustments. You can only make them in group retained earnings, because any intra dealing at that point, whatever profit that was made from the subsidiary company after the marriage, that is going to be adjusted under the group retained earnings. Then for the subsidiary, there's no any other space. It's not like a dual carriageway where you can do all the things you want to do. It can only be done in the net assets in the subsidiary. That's all. Okay. This scenario is P sells 100 kwacha goods to S at 125, and S has not sold the goods on by the end of the year. So it means that there was an unrealized profit of 25 kwacha. So that unrealized profit, because those P that sold, will have to go and adjust the working 5 on group retained earnings. So there's this question. It reads, statement of financial position as at 31st December 2018. We have the balance sheet, additional information. Yakosa bought 80% of the equity shares in Tamanga for 800,000 kwacha. When the retained earnings were 150,000 kwacha. Non-controlling interest is measured using the fair value method. The fair value of the non-controlling interest was 200,000 kwacha at the acquisition date. During the year, Tamanga sold goods to Yakosa at 120,000 kwacha based on a markup of 20%. Half of the goods remain in inventory at the year end. Prepare the Yakosa Group consolidated statement of financial position as at 31st December 2018. So what I'm going to do, I'll allow you to work on this question for 20 minutes. Cross-pollination of ideas, Victor, is allowed. You can cross-pollinate with Luke.
That's okay.
Then after you're done, after 20 minutes, we'll come in and we'll start working through it from the first part up to the last part. Then you'll be telling me, here, Coach Carter, we have scored. Here, we misunderstood the concept. Here, we have actually done the correct thing. That's the best way to learn. Do not fear to make mistakes. If there's any place where you should make mistakes, it is at our academy. Because in the exam room, you make a mistake, you have to rewrite.
Okay.
Okay. So I'll mute and leave a bit. I guess you made some progress. Let's do it together in Excel.
Okay.
I know we balanced it. We go stage by stage. Sorry. So all is required is practicing, just heavy practicing so that it becomes part of you for second nature.
Okay.
Yeah.
So we start with working one. We know the parent is 80%. The subsidiary is 1 minus 80. Okay. We got working two, which is the net assets in subsidiary. So we have three columns. We have at report date. We have at acquisition. And we have post acquisition. Post acquisition. Then we'll do copy and paste. So we have equity share capital. And just do this. Share capital and retained earnings. Retained earnings. Because there's an element of PUP, so we are going to put the unrealized provision for unrealized profit there. Just leave a bit of some space. So at report date, equity share capital is 200. So I have 200 here. Is 200 there. This minus that. You have nothing. Retained earnings. Retained earnings, we have 400 at report date. We'll have to compute the PUP later on. Then at acquisition,
150.
150. So we can do a sub working, but ideally you can call this as working 6 so that we don't disturb the flow. You can push it down on the unrealized profit. So you should always be careful with the language. When they say markup, meaning that it is at cost, whereas margin is on revenue. So most people get confused on this. So they're saying during the year, Tamanga sold goods to Yakosa at 120,000 based on a markup of 20%. So based on a markup of 20%, so you're saying markup is 100%, meaning that the profit, the cost of sales is at 100, the markup at 20, because it's 20% of markup, meaning that revenue will be at 120%. So it will be 120 divided by 120. So to be like this, I always go back to grade 3. Is it grade 5? The way we used to do this is grade 5. So I always say 120 equals 120%. Then I don't know what it is there. But all I know is that the profit is 20% of that, like this. So it means then that PUP is, maybe I can do it from here, is 120 times 20. You remember the cross multiplication?
Yeah.
Divided by 120 there, giving me PUP of 20. Giving me profit of 20. It's not PUP of 20, but it's in. Then from here, we have a 10%. You have 50%. So this is the profit that was recorded. Recorded by the subsidiary, isn't it?
Subsidiary.
The subsidiary, right?
Yes.
So then we need now to get the unrealized profit, which is basically 50% of this, right? Because 50% of the goods were not sold to the outside world, which gives us 10. So we know that in this 400, we need to adjust the retained earnings downwards by the unrealized profit. So say equals minus that.
Yeah.
At acquisition, we leave it as is because any transactions that were done up to the point of at the date of before the date of acquisition, that was normal, and the profits, whatever profits were recorded, were normal.
Okay.
So we have the 240. So we go back to working 3.
Yeah, working 6. Yes.
Which is goodwill, right?
Yeah.
Yes.
On goodwill, we start with the fair value consideration, which is basically the purchase price.
It was 800.
800. Then we go to the NCI. I think in this question, we've been given a fair value, isn't it?
Yes.
Yes.
At the point time of acquisition, which is how much?
200.
200.
200.
Makes it 1,000.
Giving us 1,000. Then we look at the net assets.
Net assets.
At acquisition. Here you don't struggle, you get it directly from here.
350.
I hope this is what you did.
Yeah, okay.
Yeah. So meaning that we get our goodwill, which is the 1,000 minus the 350, giving us 650. Then now from working 3, we go to working 4, which is on NCI. So we start at the acquisition.
The fair value was 200.
So it was 200. So what we do, we just pick whatever is in the working 3. Then post-acquisition.
Post-acquisition. It's 20%.
So the post-acquisition, we got working 2 in here. times
Oh, it changes now.
the
Yeah.
NCI percentage, which gives us that. Then we got working 5. Just like building a plane, just following the order. Group retained earnings. So we have the parent company at 100%. Then we have the subsidiary at 20%. So in the balance sheet, what are we told? It is it is 800.
100, yeah.
Yes.
Then here we go and pick, because it's post-acquisition that we are looking at. We pick this times the 80%. That. Now we can do our balance sheet. So whatever XXX consolidated, blah, 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 blah. You know what to write there. And you have to write the correct thing, because you may miss a 1 mark on this one.
Okay.
Yeah.
So we start with goodwill. Pick it from here.
650.
Then what else do we have?
PPE.
Okay, PPE. And the current assets. So on PPE, what was the total?
1.4.
So 1,400.
Yes, and then 1,000.
Then the current assets?
1,300.
1,300. Then we are on equity share. You only pick for the parent company. Let's do this. You can even pick this here just for formatting purposes. Move this side so that I bring it somewhere here. So on equity share capital, which is 500. On retained earnings, which is group retained earnings. Because we go to working 5. Which is that. Then we have the NCI.
Looking for.
Which is working 4. And in the balance sheet, the best you can even show a note here. So where you show W4, W whatever.
Oh, okay.
Actually, that is advisable. So in working 4, we have this. So we'll do that. Bring it to this side. For some, this will close. Then we have the liabilities.
Liabilities. 1,600.
1,600?
That's it. 1,600.
1.1 plus that's 500.
Then here as well on the current assets, do not forget to adjust. Remember that unrealized profit, you're actually adjusting your stock, because of the one that is selling, the other one that has bought. The one that has bought would have overstated their inventory. I don't know if I know I didn't explain that. I just said the credit inventory, and on the unrealized, I said credit inventory, debit retained earnings. So on inventory, what you are saying that the company that bought, for them, it was considered as a cost. Right?
Yeah.
So let me just put it in the right perspective. First, we are saying on the PUP, the adjustments are debit, retained earnings, because you are trying to reduce your retained earnings. So you're debiting, and the credit inventory. So for example, the parent company sold, okay, that's the same example. Let's say sold, the parent company, let's just say sold goods, sold, how much? Okay. P sold the goods at 120 to S. So in the books of S, the cost of these goods would be how much? Would be 120.
120.
In the books of P,
it will be
sales.
Sales, yeah.
Of 120. Victor, is it okay?
Yes.
So we are saying we overstated here because it's still within the group. This is the inventory is overstated by the unrealized profit. So this is why you have to adjust
the
current assets.
The inventory.
So yeah, so you say adjust PUP. So to be that 13 equals minus, I'll say minus 10 because I'm picking from here.
Do you have to show the working for that adjustment, or you can just do it
on the face of the balance sheet?
Yeah.
Where you have inventory, where you have current assets, you just say one whatever. What were the numbers there? 700 plus 600 minus 10.
Okay.
But if you want, you can even show this, what do you call it? Double entry. You can just show the double entry so that the examiner knows what you have done.
All right.
Okay. This is, so can you just tell me how you managed to do this, to tackle this question?
Yeah, I think the unrealized,
okay.
The unrealized profits missed everything.
Yeah.
Because we didn't consider that half of the first thing that we didn't consider that we were given markup. So we are supposed to use the cost. And then the second one, the issue that half of the goods were still in stock.
In stock.
Yeah.
So like I've always said, people get confused on this one. Look, markup, you look at cost.
Okay.
Margin, always when you talk about the margin, is sales. Always.
Yeah, I think that's where our problem was.
So if you say a margin of 20%, then automatically you are saying sales is 100%. If you say a markup of 20%, then you are saying sales is 120%. Then you use these numbers. I always go back to my grade 4 knowledge.
Yeah.
Then you do your cross multiplication. This palm and that palm. That's what you do.
Yeah.
Okay. Let's go back to the presentation. We wrap up. So if you have provision or unrealized profit or non-current assets, it will still be the same thing. Meaning that you have to credit your property, plant and equipment and debit your retained earnings, because your retained earnings was actually overstated. So you need to actually reduce it to adjust it to correct levels. So you do the same thing on the double entry. So it's the same thing here, guys. If it is the subsidiary that has sold, you adjust working 2. If it is the parent company that has sold, you adjust working 5. And I did actually explain the reasoning behind that. So don't memorize this. So just a basic example or an illustration. A parent company sold an item of PPE for 250,000 kwacha to its subsidiary on the last day of the reporting period, when its carrying value was 200,000. The intra-group profit of 50,000 needs to be removed so that the PPE is held at the carrying value to the group of 200,000. That's what you do. But then what are you going to do? In an adjustment to be required as follows. Obviously, you have to debit the retained earnings and credit the proper plant and equipment. So on the retained earnings, even in working, because this is the parent, so the parent company, so basically it's working 5. Then fair value adjustments. So we are saying bring in fair value of identifiable assets and liabilities on line-by-line basis into the group or your financial position, statement of financial position. That could be your property, plant and equipment, your inventory, or your contingent liabilities. You adjust the subsidiary's net assets, working 2, obviously at date, at SFB date, which is the report date and acquisition column, which it will be like this. So those are the adjustments that you're actually going to do in the net assets. the same thing that we did on PUP, but if it is on a revaluation, you show any, if there was a surplus on the revaluation, you are going to show it there. And any associated depreciation that came in or that should have been adjusted downwards, you will show it under extra depreciation so that you have your numbers nicely. I know we still have quite a number of questions to look at. This is when we have started officially. Then on your property, plant and equipment, because you have to adjust it, if it was valued upwards, you add that particular surplus minus the depreciation. So that is what you're going to have. If it is on contingent liabilities, also contingent liabilities, it shall affect the net assets. You have to show that. And in the balance sheet, under liabilities, you have to show the contingent liabilities. That is the contingent liabilities, because what is going to happen is that it is going to be in the notes of your balance sheet. It's not going to be on the balance sheet, but it's going to be the notes. So the examiner will state that there was a contingent liability of this so much. So for you, then you will have to make those adjustments. One, in the net assets in the subsidiary, you have to actually show or subtract the liabilities, because then you have to debit your retained earnings and credit your contingent liabilities account, which will affect your liabilities on the balance sheet. So this is just a question. It says a parent company, or an illustration for that matter. A parent company acquires a subsidiary at the start of the reporting period, and there's a contingent liability of 100,000 disclosed in the notes to the subsidiary's account. So you will need to make sure that these contingent liabilities, because it's affecting the subsidiary, meaning that it is going to affect your net assets structure of your subsidiary. Therefore, you need to go and subtract it from your table, working two table. And that subtraction, ideally, you as accountants, you will know that ideally what you are doing is you are debiting the retained earnings. Then you are going to debit to credit the contingent liability. So this is how it is going to work out. Let me just. Sorry. So you are going to have the contingent liabilities there. You are subtracting it, or in short, you are just debiting your retained earnings. Then you are going to show it on the balance sheet under contingent liabilities as 100. So all you are doing is you are crediting contingent liabilities and debiting the retained earnings. So tomorrow we'll have to go to other issues. Now it is on the consideration, because when the company is being acquired, there are a number of ways in which to be acquired. They may be deferred the cash consideration, and you may have a share for share exchange, and all these are things. These are things that we'll have to look at tomorrow, or whichever day we're going to agree a meeting. So I end here. Before we start looking at any other business, how was today's lecture? You have to what you normally say is you have to check in. If you go to the hotel, you don't just leave after whatever. After I've spent some days there, for 3-4 days, you have to go by the reception and check in. So you're actually not checking in, you're checking out. So tell me your checkout views on today's class.
Yeah, quite interesting. Yeah, bringing in these technicalities, you have to master them. Because without mastering, like what the question that we did, I think you would stick with the unrealized profit was affecting almost 3 of our workings there, and then the balance sheet. So you get some of the things wrong. Instead of getting the 100%, you can get 70%, 60%. So it was quite interesting. If we can get before the next lecture, if possible, if you have questions with this, so that we attempt a question, and then we send it to you.
Okay, I'll certainly send that. Look, your checkout views.
Yeah, I think interesting, like Victor had said, and it's basically an eye-opener for me, and the way you are putting it across, or you are explaining it, makes it easy to understand, and also easy to grab the basics per se. Instead of trying to use your memory or try to claim it, you get the basics right, and then it should be okay. Because right from that question that we did, we overlooked that issue of the markup, and obviously after you explained, I think we won't get it wrong. And like Victor has said, we need to practice more for us to be able to grasp the concepts. No, yeah. That's all I can say.
Yeah, sure. So I'll certainly send some questions just after this, maybe after 30 minutes or so. Are we meeting tomorrow? How are your programs?
If possible, Luke, are you around? If possible, we can do same time. If you're around.
Me, I'm not going to my ranch, so I'm around. I'm not going to the village.
Okay. Are we not able to start it earlier?
Yeah, we can start at earlier. Tell us what time. We can even start at 7, 6, 5, 4, 3.
Or maybe we can start at, Victor, how early can you start?
Now I can start as early as 8 o'clock.
Yeah, let's say 8:30 to 10:30.
Okay, so see you tomorrow. Look, I'll be waiting for the course from your colleagues, and what you have done, so that you just check. Yeah.
Okay, that's fine.
Okay, you can tell them they can call me now that we are free.
Yeah, I'll let them know that we are done. Yeah.
Okay.
Okay.